Quantitative easing by central banks has caused a number of unintended consequences for investors. The first is how relevant the fixed income component of multi-asset class funds remains. And despite the negative real returns investors have suffered in money market and bond portfolios, investors are still hesitant to invest in equities. Earlier, Warren Dick spoke to Nick Lee, investment director at Ashburton, to get his views.
With quantitative easing being one of the biggest trends in the market at the moment, many clients and investment managers have been considering whether fixed income is a non-event. Today we are joined by Nick Lee, who is an investment director at Ashburton, to describe and discuss some of the unintended consequences, I guess, Nick, of quantitative easing. You're based in the Channel Islands, and obviously real interest rates are negative for most of the developed world. So what does this mean for the multi-asset class portfolios you run?
I think, well, government bonds we think are likely to produce poor returns over the medium term. Effectively, with 10-year US Treasuries, for example, at 175, and inflation, say, will average over the next 5 years 2% per annum. Effectively, your capital is just being gradually eroded. So, government bonds we feel will be a poor investment over the next 5 years. Corporate bonds we think are slightly more attractive, but you're moving more down the risk curve. There's a higher yield, and also high yield bonds are also yielding sort of around about 5 or 6%. Look attractive, but it's basically you're going to get your coupon back rather than capital growth. But having said that, I think government bonds do have a place as a potential hedge against sort of sharp volatility within the global equity markets.
Volatility is something you expect still going forward. Just talk us through why you expect that with reference to some of these macro forces at play at the moment.
I mean, if you look at global equities, they look relatively good value, particularly against bonds, and they also look historically sort of valuations are relatively low. So that's a positive for equities. However, we have had a very, very strong run from the lows in November to the recent highs that we've seen from the S&P 500, for example. But it's interesting to look, although the S&P 500 has hit sort of new all-time highs, what has actually been driving that move, the latest move over the last quarter, for example, and it's been defensive sectors, the pharmaceuticals and the staples, which is is not a normal occurrence in a sort of a fairly strong bull market. And I think that is showing that investors are concerned about the global economic outlook, and the effect that we're of the fiscal tightening and also government spending cuts to sort the US sort of balance sheet out. How is that going to restrict growth going forward? Because in the US you have sort of fairly stable, improving housing market, and we're seeing credit growth, but that's been offset to a certain extent by the tax rises and government spending cuts.
So we're seeing this bull market, positive returns from stock markets, most developed stock markets last year as well. Yeah. Yet we talk about this investor anxiety preventing them from being invested in equities. So you've described the situation where large amounts of capital, despite earning negative real interest rates, are sitting on the sidelines, waiting for, I guess, better days. But why do you think, even after these good returns we've seen recently, we still have so much money sitting waiting to get involved in the equity market?
I think it's probably still a hangover from the sort of 2008, 2009, sort of where we saw significant, very, very sharp falls in the stock markets. And I think investors are sort of probably more concerned about the return of their capital rather than returns on their capital. If one analyses the mutual fund flows, there's this big talk about the great rotation, which i.e. is the move from bonds into equities, which doesn't actually, if one analyses the mutual fund flows, it doesn't seem to be coming through as yet. What we are seeing, though, is very, very strong mutual fund flows into equities. but this is basically coming out of money market funds rather than bond funds. We're still seeing inflows into bond funds.
That is surprising. I must be honest. When we hear people, investment managers coming from abroad and telling us that people are sitting in cash overseas to a large degree, whether it be in bonds or money market funds, it surprises us. But you also run a portfolio of stocks for Ashburton, a very high conviction portfolio. Tell us about some of the opportunities you've been finding in that portfolio.
Yeah, I mean, it's a portfolio of 20 stocks. They're big, diversified, sort of global companies. They may not sort of hit the headlines all the time, but they generate decent cash flow over time. Profits are stable, and sort of they normally don't sort of throw up too many surprises. And I think those type of stocks over a sort of medium-term basis will give you good capital growth, but also good returns in terms of income, dividend yield, and also share buybacks. So what we're looking for is companies that have good sort of all the sort of good underlying fundamental attributes. But I think the most important, really, in our mind, is that they're able to grow and sustain their dividends.
Just to dig into that a little bit more, in what sort of industries are you finding companies like that? And can you name a couple of them for us?
In terms of the portfolio, we're relatively well diversified across. We look at it from a global sector point of view rather than from a regional point of view. So the aim is to find the best companies that we feel the best companies within the various major sectors. In terms of the staples, we like Nestlé a lot. It's a consistent. It's a very consistent company. It's got a good dividend of 3.5%, and that is growing. They're also buying back shares, and so that's the type of stock we're looking at.
Is it when you make these decisions? Is it based on kind of larger trends as well, or is it strictly on valuation for some of these companies?
It's both, really. What we look at is the big macro drivers. And one, for example, would be, and this is where Nestlé fits in nicely, is the emerging market consumer. In China and also India, there is a growing middle class, and particularly in China, there is a sort of the aim of the government is to shift the economy much more towards consumption, i.e., the consumer, than from sort of infrastructure spend. So that's a big positive driver for a range of companies.
At the moment. So if we have a look at a couple of the large resources companies, do those feature in the portfolio at all?
No. I think the problem we have with resources is, or the commodities generally, is we've had the commodities super cycle, and we're probably sort of coming towards the end. And I think what the aim of the portfolio is, we try and take although we diversify, we try and take cyclicality out, because share prices obviously will be much more volatile.
So it's essentially the end of the super cycle. Is that based on any one attribute at this point, or is it just generally that China is not going to be consuming the same amount of resources going forward?
Well, you say that, but I mean, China is still growing at 7%. I know they disappointed today, but they're still growing at sort of 7% plus. And if you sort of annualize that growth, the economy is getting bigger and bigger and bigger. So there's still sort of underlying demand. But what we've seen is commodity prices have been very strong, and that creates more supply. And as supply comes on stream, that reduces the underlying price.
We talk about the emerging market consumer, but we've got a couple of very large financial institutions, both in the UK and America, that appear to be cheap at this point, and also have extensive dealings and activities in the emerging world. Have any of those tickled your fancy?
In terms of the banks?
Yeah.
I think in terms of financials, we've gone more with American banks. So we hold JP Morgan, which we think is sort of a leader, one of the leading banks in the US, and we're leaving sort of the European banks, particularly periphery European banks, well alone. They are very volatile, and at some stage I mean, there looks as though there's relatively good value there, but I think their underlying balance sheet is still, there's doubts over that. And interestingly, with the bail-in of Cyprus, any deposit with a bank over 100,000 euros could get pared back. So what you may see is people taking their deposits out of the periphery type banks and putting it into the safer banks, and maybe in the UK or Germany, and then that then compounds worsens the situation for the periphery banks.
Nick, I wanted to maybe touch on that a little bit. Cyprus is such a small part of the EU. Why is anyone even bothered? What's going on in Cyprus? I mean, it's such a small part. It's regarded as a tax haven, and there are many people in Europe saying, well, they kind of deserve it. You know, people there have been avoiding tax by depositing their money and using Cyprus as a capital center. Why has the whole world been shocked and, I guess, riveted to what's been going on in Cyprus?
Well, one, it was the sort of the unconventional way of how they've sort of refinanced the banks by taking a haircut from the depositors.
With no prior warning.
With no prior warning, and I think that's then made investors think, well, if Portugal, Spain, Italy, if conditions get worse for whatever reason, that could then happen there. So it's more a contagion effect. Oh, and it's a bit like Greece. Greece, you know, was still a relatively small part of the European zone, but it was the contagion effect because people, banks elsewhere in Europe, held bonds in Greece, and I think, well, funny enough, a lot of the Cypriot banks had big holdings in Greek debt. So.
A double whammy.
A double whammy. Yeah.
I think, Nick, just to maybe talk us through, you know, the long-term effects of what's gone in Europe. You know, it's been a good 4 years, 5 years since this crisis has emerged. Are you seeing signs in your own home country, in the United Kingdom, and especially in these peripheries, that the governments are managing to reduce the debt in real terms at least, or controlling the public finances so that going forward the same sort of budget deficits that have got them into this situation are not going to be seen?
I think things, for instance, in Spain, things are improving, but it's kind of a double-edged sword. You're trying to sort your fiscal spend your fiscal policy and also your spending cuts, but at the other side you want growth, and it's pretty difficult it's a difficult thing to do, you know, both at the same time. I think it'll take time, and I think it'll take a long time. I mean, the economic growth within the region is, you know, one would have expected poor growth within the periphery, but you're starting to see France sort of economic conditions in France are starting to deteriorate a bit, and even in Germany. And then we have the UK, which is just sort of grinding along at sort of very low growth, and it's because they're trying to get their house in order, but they're not focusing on growth. So it's sort of it's a difficult situation, which will take time to mend.
Last question, and a bit of a tongue-in-cheek question for you. We were two days away from the state funeral for Margaret Thatcher. Is is the United Kingdom a better country because of her?
Yes.
There we
no,
go.
I think it is, because I mean, I remember those times. I'm sort of old enough to remember the power cuts and stuff like that. The UK was just totally controlled by unions. It was the poor man of Europe, and it needed someone to come in with the will and the sort of single-mindedness to actually sort Britain out, and she has done. I mean, obviously, sort of the feelings about her are either you love her or you hate her.
Extremely
and
divided.
There's probably nothing in the middle. It was sort of, but I think the UK is a much better place for it. I mean, some people argue that I don't think what she did then actually created the financial crisis. I think that was left for other governments. But no, I think she did well for the UK.